All right, so we're back to the PowerPoint, the investment portion of the presentation. Just to recap, we're going to go a bit over about it's like savings. So, you know, when you save money, your money that's in that account earns interest. So you're paid a percentage of your total balance each time that interest is added to the account. And so as the balance grows, each interest payment is larger than the one before because the base has increased. So this is what's known as compound interest. So it's one of the most kind of valuable tools that you can utilize in your life for saving and investing. And so, that's just what happens in a normal savings account. So think about investing where compounding can be even more powerful since the rate of return is typically higher on investments than on savings. You have much more to gain by reinvesting your earnings to increase your account balance. So, when you're getting earnings on your investments, you could keep, that interest payment towards yourself. You could pocket that, kind of use it as income or what have you for whatever your needs are. However, it would be best in your best interest to kind of keep that payment and kind of recycle it into your investment so that compounding works for you. So yeah, one of the easiest ways to reinvest that interest is to sign up for an automatic reinvestment plan when one is available. And so yeah, just a word of caution, you won't have a positive investment return every year, so your account value may not grow even if you reinvest, but this is going to be the best way to utilize that tool, that compound interest, is to kind of let that snowball get bigger and bigger for you in the positive direction. And so yeah, just how credit card debt with those high, absurdly high interest rates that snowball in the opposite direction, decreasing your net worth. Um, you could easily utilize that compound interest in the opposite direction to positively affect your net worth, increase that net worth. So um, then we'll talk about the ups and downs of investing. So, you don't have to work on Wall Street to be an investor, but you have to be willing to spend some time choosing investments and do the research to be, just do the research, stay tuned, be patient. So, generally speaking, the longer your money is invested, the larger your account value will be. And so that's thanks to the power of compounding that we mentioned previously. However, it you, the prices fluctuate greatly. So sometimes your account value is going to be high, sometimes it's going to be low, sometimes it can be low for a while. And so really you don't want to sell in this scenario. This was called panic selling, and that's the last thing you want to do because you're going to be losing out on potential earnings. Because historically, the stock market has always it's always fallen, but it's always gone back up by more than it's fallen. So over decades, really, the value is going to be more than what you initially bought it for if you just give it that time to go over the ups and downs to increase its value. And so that's why having savings on hand, like that 3 to 6 months worth of expenses, is really important to have to kind of help you weather these ups and downs, so that way when you're down, you're not super stressed or worried and end up selling and missing out on potential gains. So you can't predict the timing of this up and down cycle, so your best strategy is really to sit down, sit tight, and just let your money grow over the long run, over those decades, right? So most people's financial goal is to be retired by by that retirement age, 65. So the earlier you get to investing, the more time that you have to let your money grow in the stock market. And so with that time that you can allow yourself, the earlier you start, the more flexible you can be with the way that you invest. And so with that said, the way that you invest, it's important to bring up balancing risk and return, because when you invest, you're looking for a stronger return than savings provides, but the potential for a greater return goes hand in hand with taking more risk. So just to clarify, the larger potential return, the greater risk that you're going to incur. And so just because there is just because you're taking that risk, that's not going to promise that you're going to get a really, doesn't promise that you're going to hit the jackpot. And then taking low risks doesn't isn't going to make you rich either, but you're going to be really certain that you'll be able to get at least some return, even though it's going to be low. So, one investment risk that you face is the possibility of losing money, which happens if an investment drops significantly and you sell at a loss. But that's why you want to have your savings to fall back on. That way you don't have to sell when your stock is down. Another risk is not really realizing a strong enough return to meet your goals, and so this happens if an investment doesn't gain as much as you anticipated. So you really just have to assess kind of where you are and how far your goals are to really determine the right level of just the right asset allocation for you. Like, do you have enough time to be aggressive and try to get that high return along with the risk, or do you really need to kind of take things slow, take a step back, and just make sure that you're getting a nice, steady, low return, like low return but insured. So you just part of investing is getting to know what your risk tolerance is. And so there are a lot of investments out there, and there's just such a sheer number that it can be overwhelming. But most investments can be grouped into three big categories, which is cash, debt, and equity. So cash investments are savings. When you buy an insured CD or a T-bill, you know that you'll get your principal plus interest back at the end of the term. With debt investments, which are bonds, you're actually loaning money to a company or government that issued the bond, and they're promising to repay you the amount of the loan plus interest. But because the market price of a bond can drop or a bond issuer can default and not repay, bonds are usually more risky than cash, but they're actually less risky than stocks. So stocks are equity investments, and when you buy stock, you have a share of ownership in the issuing company. Stock returns are tied to the fortunes of the company and what's happening in the overall stock market. So that's why stocks are very volatile. They're going to be more risky than bonds, which is less risky than cash, or more risky than cash. Sorry. So when it comes to thinking about all these different investments and researching different bonds and stocks, it can be easier if you're new to investing to look into mutual funds and exchange traded funds. So funds are pooled investments. They combine the money they raise from selling shares to investors to buy portfolios of stocks, bonds, or sometimes a combination of stocks and bonds. So professional managers choose the investments and decide when to buy and when to sell. So each fund has an investment objective, so that can be growth, income, or something specific like technology or energy, certain industry like that. So with some research, you can find funds with objectives that fit your investment goals, and you can diversify your portfolio that way without having to be, if you're not confident doing the research yourself. So when it comes to actually allocating your assets, it's up to how you would decide to allocate your money based on your risk tolerance. So do you want an aggressive portfolio, which is going to include more equity, more stocks than it is going to be bonds, because you're looking for that higher growth since you have the time to take the risk on? Or are you going to be a more conservative portfolio, like more bonds than stocks because you're near retirement age, or that you want to take some time off of work to go to grad school, things like that. So that's what allocating your assets is like, or entails. And so there's no right way to allocate. So it just depends on the goals that you want to meet, the time that you have to reach those goals, and the amount of risk that you're comfortable taking. And so regardless, your portfolio has to be diversified. So diversification means buying a variety of investments of each type rather than just one or two. So stock in companies of different sizes and different businesses, things like that. So it's smart to diversify because no single investment or type of investment produces strong returns all the time. When some are having a bad year, others may be doing better. So by owning this variety of stocks, you can increase the potential for keeping your average return positive. So this is called, spreading your risk across all different types of stocks. So that, that way you do get this kind of average return that you can rely on. And so, in that way, a broadly diversified portfolio limits the risks you have to take to achieve your goals. And so that's why mutual funds and ETFs can be a convenient way to diversify, because those portfolio funds are already diversified. So, but you can never be diversified enough. So, even within those ETFs and mutual funds, which are already diversified, you can diversify even further by being into different ETFs or mutual funds that have those different objectives. So there's no limit to how far you can kind of spread your risk, mitigate that risk. So it can be really fun once you do the research and kind of do your own investing depending on your financial goals. And so your investment plan could always use some tweaking here and there. So as your life and your goals change, so does your portfolio to keep up with the changes. And so really it's just a way of responding to the market's ups and downs. If you have an aggressive asset allocation but your bond holdings have a great year, your asset allocation could end up more conservative than you intended. So you could rebalance by selling off some bonds, some bond investments, and purchasing stocks. So you don't have to reallocate or rebalance often, but you'll want to give your portfolio a yearly checkup to be sure that you're still on track. And so, with that in mind, you really can start investing yourself. Experience is the best teacher. So just, kind of getting out there and actually messing around, buying money here or there, and just learn from the experience, maybe learn from a friend, contact your bank or credit union to learn about investment services, investigate online brokerages, mutual funds, even financial advisors, and just be honest with yourself about how much risk you're comfortable taking. And so that concludes kind of the investment portion. And yeah.